Hey everyone, this is Angel Mondragon here with PlutusX. Once again, we're going over order types. This is what allows you to execute trades on your trading platform itself. It'll help you actually be free as a trader instead of looking at the market 24/7 like a hawk. So this is a very important topic. I believe this is the last video in the beginner course, and I'm excited to talk about this, guys. Let's get into it. Types. There's three main order types, and then three other order types. So the three main are going to be market execution, limits, and stops. The other types are going to be stop loss, take profits, and trailing stops. And those are actually linked to the main types. So we'll just dive right into it. Market execution. A market order is an order to buy or sell at the best available price. If you remember, we have the bid and ask price, so this is going to be the best available price. Obviously, the spread is going to be what the broker or the exchange takes away, and that's something that you can't really get away from, except on Binance. If you're using the Binance coin, you can actually get away with it. That's a different topic. So that's market execution. Basically, what that means is if Bitcoin is trading at 5,500, you're going to be executing an order live at that particular moment at that best available price. Limit order. A limit entry is an order placed to either buy below the market or sell above the market at a certain price. So we can see here, for example, Bitcoin USD is currently trading at 6,500. You want to short the price if it reaches at 67.50. You can either sit in front of the monitor all day like a hawk and wait for it to hit 65.50, which at that point you would click market order, which would be a market execution. Or alternatively, you can set up a sell limit order at 65.50. At that point, you could just walk away from the computer, let the market do its thing. If it hits that point, great, it's going to short it for you on your behalf. Find out the best market price available. If not, then the trade wasn't a setup and it nulls out essentially. It doesn't happen. To the left, we have a little diagram of what it looks like. So a buy limit, an order is placed below the price, and then the price will actually go down, hit that buy limit, and then go back up. Similarly, we have a sell limit, and order price is placed above current action price, and price will go up, hit that sell limit, and then come back down. So that's just a quick little diagram to kind of explain a limit order. This is something that I use consistently when I'm trading as well. Next one is a stop entry order. A stop entry order is an order placed to buy above the market or sell below the market at a certain price. Another example is going to be Bitcoin USD is currently trading at 6,500 and it's heading upward. You believe that the price will continue in that direction and it's going to hit 65.50. You can do one of the followings to play this belief. You can sit in front of your computer all day, like I said, like a hawk, and buy at the market when it hits 65.50, or you can set up a stop entry order at 65.50. And right here in the bold I have on the bottom, it says you can actually use stop entry orders when you feel like the price is going to continue moving in that one direction. So to the left we have a buy stop definition. Buy stop is placed above the price execution and price continues to go up. Sell stop similarly is order placed below current price action and the price continues in that downward direction. And that's the diagram to better explain what I'm talking about. Once again, I use these continually. If the trade setup is there and I'm scalping, I'm obviously going to be doing market entry. However, I'm a swing trader for the most part, so I'm using these two right here. And like I said, these two will help you just kind of step away from the computer so you're not staring at a computer screen in price action all day. The whole point of this is make money, free up some time so you can do the things that you want to do. You don't want to be creating yourself another job, right? So this is something that will allow you to step away from the computer, do your thing, and let the market do its thing. All right, the other types I was talking about, the other types, stop loss, take profit, trailing stops, are going to be obviously take profit and stop losses. These are linked to an order to prevent additional loss and also take profit when a target is hit. So we see here we have a mock-up of price action and a graph for Bitcoin over a couple of years. This is ridiculous, but let's say we made a market order at 62.50. Okay, that's the blue line. Now our stop loss is going to be the red dotted line at the 5,900 mark, and our take profit is going to be that green dotted line at the 6,700 mark. So what this basically means is after we made a market order at 62.50, if price continues to go down and hits that red line, it's going to stop out immediately, which means it's going to take our loss. We're going to walk away with an L, but that's okay because it's mitigating our loss, so it helps us prevent any additional loss, like it says right there in the definition. However, if price continues to go up in that direction and you're away from the trade, instead of having to stare at your trade all day and take profit when it hits target, you set up a take profit at your target zone and it executes that take profit. You come out with some profit and a W. Now there's certain things that we'll talk about in a later part, especially when we're developing strategy for you. We can implement something called a trailing stop. So instead of taking profit, we can implement a trailing stop. And what a trailing stop is it allows the stop loss to follow an X pips from the price action using a high water mark level upon execution or target price. So the X pips means you can set the range yourself. You know, typically 10% is kind of what I would have, or 20 pips if I'm scalping. It depends on your risk to reward once again. And then a high watermark level means as the trailing stop moves upward, as we can see here on this red dotted line, once it hits a maximum high, it's going to go sideways. So it's not going to go down and follow price action exactly. It's only going to follow when price action goes up. So we can see here on the blue line, we made a market order at 5,700. We set the trailing stop. Below it, price goes up to a little bit above 6,000, and the trail stop, and then it starts declining to 6,000, right? And we can see that the trailing stop goes flat. It doesn't descend with price action, it goes flat. And then when price action hits 6,000, we see that it starts making another rally a little bit past 62.50. We see that the stop loss also trails behind that as well, and it creeps up as well. And then we notice that when it hits, let's just say arbitrary numbers, 6,400, that price starts descending down back to 62.50, but we see that the trailing stop itself has gone flat. It's not descending with price, it stays flat at that high watermark level. So that's the highest point that it's been. And we see once it hits close to that 62.50 mark, that price starts making another rally close to the 65.50. And what happens to the trailing stop? Well, you guessed it, it actually starts going up with it. Now, when price nears that 62.50 mark, what happens? Well, price actually starts descending, and it starts descending rapidly. But what happened to that trailing stop? Well, it stayed at that high watermark level at the 6,500, and that actually became your exit price. So when price action fell through that trailing stop, that means it technically stopped you out. However, you can see that you were above your market order itself, so that was actually a profit. So we can actually utilize stop losses or trailing stop losses as our version of a take profit as well. And this once again depends on your trading strategy, so it's stuff to keep in mind when moving forward and implementing and developing a trading strategy. So that's pretty much it. Those are the 6 order types, right? And these are necessary for you to become a successful trader. These will allow you to be free and not staring at charts all day as well. So the next topic we're going to be going over is just bars versus candles. It's a very important topic. Just like letters help you read words and words help you read a book and a story, candles help you read charts and charts help you read pattern and structure, which help you take profit. It's a very important topic, extremely important topic. That's going to be going on in the next video. I believe this is the last video for the beginner series. We're going to be starting intermediary once we dive into candles. But that's it. Yeah, so like, subscribe to this video. Don't forget to clap on the Medium post as well. join our Telegram channel. That's where we'll be able to answer any of your questions that you may have. We're also going to be doing live webinars with Patrick, and that's where you can come on after you've gone through the whole beginner course and you can start asking us questions. We're going to be doing live trades and then answering all your guys' questions live as well. So thanks again, guys. Talk to you guys in the next video. We're doing bars versus candles. See you guys soon.